It is Street Talk today with Stephen Foster. I'm out on a job site and I'm visiting with Jason Roy. He's going to be talking to us today about construction mortgages, how to get financing either for a big job or a small job.
Great question, Stephen. Well, the difference between a construction mortgage like this place we have behind us, this is from ground up. You're doing the whole thing. There's going to be draws and it's going to be back and forth to the lender at different stages where foundation is complete, framing, windows, that sort of stuff, versus a renovation where you're taking an existing property and just bringing it back to, changing whatever you want. Maybe you're adding an addition, maybe you're just renovating the basement. So there's two different mortgages, two completely different processes.
I know. Another question. How much of a down payment do you need for a construction mortgage? Is it like 5%, 10%, 25%? Will the banks give it to anybody, or do you have to be special?
Another great question, Stephen. So usually people doing a construction mortgage have a fairly large down payment, 25, 35, 40% down. Now that being said, you can get into a construction mortgage with 5%. If you only have 5%, maybe you're not building a huge house like this. Maybe you're getting into a more entry-level house. You're building it with the builder. 5% in, you can insure a construction draw mortgage through CMHC and through the lenders.
What's a draw? What does that mean, a draw on a mortgage?
A draw mortgage basically is at each stage. So at foundation, you're going to go back to the lender and say, hey, we need some more money. And then they're going to write you a check. And then you're going to get to this point, and you're going to put some windows in. You're going to go back and say, hey, we need another draw. We need some more money. So a draw is just when you're drawing money out from the lender, and you're taking a chunk for the foundation, for the framing, for the drywall, that sort of stuff. That's what a draw mortgage is.
All right, so that's new construction. So what if I've got, a nice house here in the middle of Victoria, and I want to do a renovation on my kitchen or my bathroom or something like that? So what's the process in terms of getting money from my mortgage, and what does that mean?
Great question, Stephen. So if you own this house behind me here and you want to renovate the kitchen, you've got some equity built up in the home, you can come, we can look at your mortgage, possibly pull some of that money out on the line of credit. That'll allow you can take 3 weeks, you can take 6 months and do your renovation that way.
Okay, that sounds great, but what the heck does pull money out mean? Because I love to pull money out if I had it, but I'm a magician and, there's no rabbit in my hat. So what do you mean exactly by pulling money out of your mortgage?
Okay, so pulling money out of your mortgage simply means you own the property, you owe X amount of dollars, it's worth X amount of dollars. That difference between what you owe and what it's worth is that money that you can pull out of the property and use for your renovations or whatever else you want to use it for.
Great. Is there a maximum amount that I can pull out? Can I take the cash out right up to the amount that I owe, or is there some sort of a limit to what I can actually take out, just in case?
Okay, great question. So the maximum you can pull out is not up to what it's worth, but up to 85% of what the value of your home is.
Well, that is a wrap for today's session of Street Talk. If you have any questions, give Jason a call, and if you want to talk to me, you know where to find me. See you next time.